Welcome to our Mindful Moments webinar, which we renamed from a Moment of Insights and Updates. These webinars are designed to give our advisors, consultants, and clients great knowledge and insights into best practice when it comes to investing. Our panelists today are from Mazi Asset Management, 91, Present Investment Management, Funds at Work, and Momentum Investments. We will also give you an update on our multi-asset class portfolio ranges, what we've been doing in the responsible investing space, and tie it all back into our outcome-based investing philosophy and capabilities. Just some housekeeping. We applied for continuous professional development CPD points. It is important to please watch the full session and add your ID to the CPD section so we can verify your attendance. The CPD certificates will be mailed to you after the Financial Planning Institute accreditation is finalized. Please also feel free to ask questions in the Q&A section, and our speakers will either answer them live or get back to you after the event. You will also find more information about our speakers under the speaker tab on the top menu bar, or if you scroll down. I do hope that you enjoy this session and find it valuable. Please make sure you stay tuned until the end of the webinar, as we have a very important announcement from our Executive Head of Investment Management and Institutional Investments, Theo Tereblanche. First up is our Chief Executive Officer, Jeanette Murray, who will do a brief introduction.
Hello everyone. Firstly, I want to say a huge thank you for joining us for Momentum Investments Mindful Moments episode. Today, you will hear how our teams are adapting and positioning our business for the future. Our theme is navigating change with inclusivity. In today's world, change seems to be our only constant. In fact, John F. Kennedy once said, "Change is the law of life, and those who look only to the past or present are certain to miss the future." We have to navigate a global pandemic, geopolitical conflict, and volatile economic variables and markets. Our investment teams have decided to refocus their perspectives and become comfortable with constantly adapting rather than constantly trying to manage the next big thing. The world of investments in 10 years or even 2 years will look very different to today, just as today it looks very different to last year. At Momentum Investments, we believe that the key ingredient to future-proofing our investment success is being able to navigate uncertainty with inclusivity. What do we mean by inclusivity? Well, August is Women's Month, so it is fitting that our first panel discussion, moderated by our CIO Sonja Saunderson, will give us some insights on the investment management industry today from a female perspective. I am a strong advocate for women empowerment. In fact, values-based research by Richard Barrett found that men and women bring inherently different values to the table, with men predominantly embracing values like strength, competition, and logic, and women typically embracing values such as compassion, empathy, and care. In an uncertain future world, we will need a blend of the best of both worlds to excel. After that, Deputy CIO Mike Adsitz will then moderate a discussion on some of the changes we are seeing in our world. Amidst the changes to Regulation 28 and the relaxation of exchange control, it is important that we remain attuned to the need to adapt and evolve. Our investment solutions are designed to be able to navigate uncertainty. Our portfolio managers, Mohammed Zipta and Kudzai Ziso, will give us an update on our Factor series. The Momentum Enhanced Factor portfolio range is managed in terms of our outcomes-based investment philosophy, where we design the portfolios to maximize the probability of achieving the inflation plus return target, while continuing to meet the portfolio's risk targets. Our outcome-based investing approach is more than an investment philosophy. It is a belief system defining the way we manage and grow our clients' investments. We are proud of this, and we believe it will allow us to continue to meet our clients' needs, even in an uncertain future world. It all comes down to placing our clients' goals at the center of our investment process. Throughout the session, you will hear from our thought leaders and knowledge experts how they are navigating change with an inclusive mindset. Thank you for joining us. Enjoy the session.
Next is a panel discussion where our panel of female experts will give you a perspective about the investment management landscape today. Moderated by our Chief Investment Officer, Sonia Saunderson.
Hello everyone, and welcome to our panel conversation about how to navigate change with inclusivity. Change seems to be the law of life. In the investment management world, we are no strangers to our own unique challenges and evolution. We therefore felt it's an opportune time to have our panel conversation in the midst of a world that continues to be characterized by change, and to reflect on how we use the diversity of skills and perspectives to deal with these changes. From a global perspective, US inflation is running at 40-year highs, and at the time of this recording, the potential risk of a recession is becoming more real. The Russia-Ukraine war continues to grind on and have multiple impacts that resonates around the globe, from the realignment of global politics, the rise of regional spheres of influence, and energy and food price increases that are adding to global inflation. Unfortunately, the recent events came as the world was just trying to get to grips with living with COVID after the worst impacts through the global pandemic, with experts debating whether we are in fact close to the end of the pandemic. In convert, this has heightened the levels of risk that we need to consider every day. When it comes to crises, South Africa is not a country to stand back with its own unique challenges. Load shedding, the finalization and the publication of the Zondo Commission reports, a president under pressure, together with the relaxation of exchange controls, as well as changes to Regulation 28, make this an extremely dynamic environment. Navigating this world that is highly dynamic requires an open and an engaging mindset, but also diverse perspectives, finesse, and patience. As this is Women's Month, we thought it's an opportune time to have a panel of ladies that are all seasoned in their respective fields to talk to us about the changing environment and how they deal with it. Let me start by introducing my panel. Wanjiru Kalima is the chairperson of Funds at Works Investment Committee and an independent trustee in the industry. Cherie Dyers is the Chief Executive Officer of Prescient Investment Management. To my right, Nina Saad is the Head of Corporate Portfolio Solutions in Momentum Outcome-Based Solutions. Next to her, we've got Unati Lewis, who's a Portfolio Manager for 91's Balanced and General Equity Strategy in South Africa. And far to my right, last but certainly not least, is Zizanda Gila, which is a Senior Portfolio Manager within Momentum Asset Management. Welcome, ladies, and thank you for your time this morning. Appreciate having you all here. Let me start a little bit with just the landscape and the market so our audience get a bit of a sense of where we all come from and what our sets of expertise are. And maybe I can ask this one of you, Unati, if we think about just all these big changes that I introed with, I mean, one of the biggest changes, I suppose, is the whole theme of global inflation and the policy pivot and how we as an investment industry are responding to this. What is your take on it? How do you position your portfolios according to that?
Thank you for that question, Sonia. As you aptly put it in your introduction, certainly there's a lot to worry about in the markets. And certainly the persistently high inflation is something that we are very concerned about. And obviously the impact it's having in terms of the Federal Reserve's response to try and curb that inflation through raising interest rates. They're having to do it at a much more accelerated pace than what people were expecting. And the real danger is that obviously that is going to destroy growth and we might end up in a recession, particularly in the US over the next 12 months. If that doesn't happen, if there's no recession, there's also a rising chance that we might end up with stagflation, where there's no growth, but inflation still persists. neither of those scenarios are very good for risk assets. And what we are doing in our portfolios, given the probabilities that we are assigning to those outcomes, is to take away some of that risk. And we have reduced our allocation to equities, both globally as well as locally, in favor of bonds and in favor of cash. And within the equities that we hold as well, we're quite mindful to make sure that we're picking stocks that are more defensive in nature and therefore are less likely to underperform should a recession or stagflation scenario transpire. So there's certainly a lot to worry about, and we are cognizant of the risks that we face over the next 12 months, particularly from a growth and inflation point of view.
An interesting time for a portfolio manager to be managing a balance fund, for sure.
Definitely. And I think if there's one more thing that I'll just throw in there as well, I think you mentioned as well at the start, is the whole Russia-Ukraine war. And it's really quite a big issue because we've gone from a world where there was an established world order between the US and the developed markets, and now there's tensions with Russia and they're spilling over to China, and the recent events around Taiwan exacerbating some of the cracks that we're seeing from a geopolitical point of view. And when you're navigating all of those unknowns, you have to be quite mindful about protecting capital.
Sure. So maybe I should move a little bit to the ladies on my left and just get your perspective, seeing as you operate in a completely different space to what Unati was just describing. Just a little bit your perspectives, Wanjira, if I can ask you, what do you see in your space as the main challenges that we're facing as an industry, and how are you responding to those?
Thank you for the invitation to come and talk about my passion, which is investing money for people when they retire. And this, from when I started, the principles haven't changed. We still need to invest so that when people retire, they have a hospital, a house, a home, and they can live with dignity. So the outcomes really are not changing. It's how we are navigating this complex world that we are now living in. And it changes every day, every week. The world we started 20 years ago is very different to the world we're living in today. A much more complex world with a lot more regulation, with a lot more people who are wanting different things when they retire. It's not just what's the do I have enough money to retire, but am I retiring with dignity? Have I got a road to get to? How have you managed my money in a responsible way? I think that's been the main change that we've seen in the last 20 years. Not just the return aspect, but a responsible return is what the main change I have seen. And the other aspect that I have seen, which has been another big change, is the role women play in this industry and how important it is to look at South Africa not just as one country, but as a completely diverse country with, younger people wanting to retire much earlier, older people wanting to work for a lot longer. So it's just a different ecosystem that we are living in. And we as trustees need to accept that we need to be on the ball every time, actually in front of the ball, anticipating change, working with our stakeholders in all these new environments.
Sure, so it's a much more multi-dimensional perspective, I suppose, on the industry that you're having.
Absolutely.
Cherie, in your world, as the CEO of an investment management company, you must have your own sets of challenges and things that you're responding to. Everything that Unati and Wanjira were already talking about. But what do you see as the main changes, and do you see those as threats or opportunities? How do you think about it?
Yeah, thank you, Sonia. It's very much the same, but also different. So if I think about it from a leadership and business perspective, I think we're well beyond the acronym that they call VUCA. So volatility, uncertainty, complexity, ambiguity. To that, we now add 2 Ds. The one is diversity and the other one is disruption. And by far the biggest one that we're all dealing with right now is post-pandemic disruption. And the effect on technology, social change, how people are being treated in the workplace. So as leaders, I think for us, the secret is that we can't apply the same skills that we used in the past. It's the definition of insanity. So basically throw out the rule book and reimagine how you think about the business. And in that is lots of opportunity, of course, which brings me to my second point, and that relates to technology. Our ability to leverage technology in today's world is amazing. So to bring that to bear in your research capabilities, in how you run your business, there's no excuse to not have evidence.
Sure.
And that, I think, is the most exciting part, leveraging data, big data in your business and making the most out of that.
It almost forces us to have to retool ourselves for the challenges of the future.
Absolutely.
Tizanda, let me move over to you and ask you a little bit, just in your space from a fixed income perspective. The South African Reserve Bank this year in June, if I recall correctly, announced the new monetary policy implementation framework. From your perspective, it's yet another change, yet another thing that we need to deal with as an industry. What is the opportunity set like? Is it a good thing? Is it a bad thing? How are we responding to it? What does it mean for you from a fixed income portfolio management perspective?
Thank you, Sonia, for that question. I will try and answer it in three parts. So the role of the monetary policy implementation framework and the impact that this will have on interest rates as well as investors. So the Monetary Policy Committee of the SAB, of the South African Reserve Bank, they set interest rate, they make interest rate decisions. So the monetary policy implementation framework, it looks to enforce those interest rate decisions that are made by the SAB, and such that they can filter through to the South African economy. So the South African Reserve Bank is trying to move from a shortage of about 30 billion rand to a surplus of 50 billion rand over a 12-week transition period. So in a bit of a context, globally, many central banks have moved away or have moved towards a surplus system after the global financial crisis, as well as the liquidity that got injected in the market. And South Africa, since the COVID, we have been struggling, or the South African Reserve Bank, or it has proved more difficult to sort of manage that surplus liquidity that was injected in the market through the dollar loans and other interventions and global flows. So that is why the South African Reserve Bank is moving now from that shortage system into a surplus system. So what this system will do, they will accept deposits from the various commercial banks and they pay them a repo rate. The South African Reserve Bank's idea is potentially that their interest rate decisions get filtered through the economy. So that surplus cash, they're hoping that it will get absorbed in the consumer market or in the lending space, in the lending market. So there has been a debate in the market of whether the disconnect between the repo rate and the prime rate, which is the cost of capital, is justified. So when we talk about cost of capital, we talk about the rate at which you and I borrow money from the commercial banks, which is prime plus or a prime minus a spread. So what this engineering by the SAB will do, it will sort of pull down, or it will make the repo rate an anchor of cost of money or cost of capital. And then that will sort of influence the banks to sort of bring down their spreads on their prime rate. So which means you might be paying, instead of paying prime plus 2, you could be paying prime and a half or even prime minus 2 on your cost of capital, because that gap, the South African Reserve Bank is trying to close it over time. So that is what this monetary policy implementation framework looks to achieve and wants to implement. In terms of investors, in the money market space, because we are working in a banking system, we are investing in a banking system. So what this will mean, because the banks will be flushed with cash and they are not looking to raise cash in the short end. So what we have seen is that the yield curve will sort of compress in the short end, and the long end not so much, because the banks still need to meet their capital requirements. They still need to raise cash in the long end. So what we have seen is that the banks are not looking for cash in the short end, so that is why the spreads are compressing. That means we need, as investors, we need to go out into other markets, which is the credit markets and the treasury bills market, to sort of get our excess alpha from that. So that is how this landscape is going to change and how it's going to affect investors going forward.
And of course, there's lots of other changes also in the exchange control world. So maybe, Nina, over to you a little bit. At the beginning of this year, when we heard about exchange control relaxation and the subsequent Regulation 28 changes, I think brought about a lot of speculation in the industry, how the fund management industry is going to respond to a potential of taking more assets offshore. Just give us a little bit of your perspective. Do you think it's good for the economy? How responsive are we as an industry? And how do you think about it from a multi-asset class portfolio management setting?
Yes, thank you, Sonia. And the industry have certainly welcomed the change, as have we, given the increased opportunity set and the greater diversification benefits we get from it, whether it is at the stock level, sectors, at the regional level, different countries and that, or even at the currency level. But importantly, there are consequences. With 45% offshore, asset managers will need to better integrate the management of their local and global assets. Currency management also becomes increasingly more important. There will be an impact on portfolios' transformation credentials because the pool of transformed asset managers that are ready and have the skill to run offshore assets is small. And portfolio costs may also increase because running global money can also be more expensive. It doesn't have to be, but it can be. As managers increase the allocation to offshore, we can expect the assets under management of the smaller boutique houses to decrease, and we can also expect a wider dispersion of the outcome in terms of returns. Furthermore, as we go offshore, asset managers won't just sell their large caps, they're also going to sell their mid and small caps. And in doing that, it's just going to increase the volatility in markets. And in that process, the SA equity market also gets a lot smaller.
Sure.
We can also expect an impact on the real economy as the local pot of assets that are available to invest in the much needed infrastructure. That part of assets is much decreased. So, I've laid out quite a bit there, but there's a lot more to talk about this. But safe to say that this change is significant, and it can be both an opportunity and a threat. And if we as an industry do not do this right, it can cost a lot. I suppose being a glass half full type of person, I believe there is plenty of opportunity here, where we as an industry should use this as an opportunity to upskill South Africans to run global assets. Yes, we can run global assets from South Africa. Actually, the pandemic taught us that and confirmed that for us, that we can actually run assets or run money from any corner of the world. And we must use this opportunity to better integrate with our global partners and collaborate with them to extract value.
Thanks, Nina. So listening to you, clearly it's both a threat and an opportunity to us. And if you listen to our previous webinar that we had, we also had expert panel talking to exactly that point and different interesting perspectives coming up. But you really touched on the theme of inclusivity quite nicely there. So let me maybe segue to that as a theme and ask you, Wanjiro, if you don't mind. You so passionately earlier talked about what you care about in the industry and why you're doing what you're doing. What exactly does inclusivity mean to you in the space that you operate?
Thank you for the question. I think for me, inclusivity is just accepting, first of all, that we are different. And once you do that acceptance, then you have to include whom previously you did not include. I have a wonderful little story around phones, that we do not all have the same hands. So phones cannot all be the same size, because some people have big hands and some people have small hands. So if iPhone or whichever makes one phone, that excludes probably 90% of the people who use the phones. So inclusivity is accepting that, we are now global, and therefore global means that your fridge in India probably uses more gas than your fridge in South Africa, electricity. It's same fridge, same objective, but it has to be different because it's meeting a different audience. It's meeting a different need. The person in India wants to cook in the morning. The person in the UK wants to cook in the evening. Everyone needs to cook. So you need to just look at the world as everyone needs to be included for you to be more successful. If a fridge is only made for a UK house, it cannot sell to an Indian house So that means Philips or whoever it is loses 90% of its market share. So inclusivity to me means making the cake bigger and making it different for different people. So in the market that I'm in, which we're all in, the pension fund, we have to be inclusive to say that when we are looking at the spread of our investors, some will be married, some will not be married. Some will have children, some will not have children. So we can't have a one-size-fits-all when we look at trustees at the pension funds. Funds at Work is an umbrella fund, so it has so many industries and so many different needs for the different members. And we have to, as trustees, have a bird's eye view to say, yes, we have to be successful, but we have to be successful for all our members, not just the traditional member who was married, who was male, who had a wife who lived at home, and expected to be looked after when both the husband retired and the wife, probably never worked. Sure. We now have single mothers. We have mothers who work until 65. We have a very different, diverse industry that we work for. So we need to be inclusive to all our members so that we can be the best fund in the country. So I'm very proud to be at Funds at Work, where we do look at inclusivity. We do look at, are they high income or low income? Do they need the retirement more than they need the benefits? Do they need benefits more than they need retirement? That's inclusivity. It's saying we are different, so we need to be smarter. First of all, we just need to be smarter and be looking out for all the people, the forgotten people, the people that have always been there, and to make sure that we are looking after a very diverse industry, because we are a diverse country. So to me, that's what inclusivity means.
I love that definition. It's a completely different take on inclusivity and diversity. Cherie, just your perspective a little bit. I mean, you've had a successful career through the industry. You've seen different places, and your perspective on inclusivity, and also maybe a little bit how responsive we are as an industry to what Panjira was just explaining. We need to be responsive too.
Yeah. Thanks, Sonia. I think inclusivity can very much be left to chance as well, because we're human beings, and as humans, we all want to feel respected and valued.
Sure.
So I'm a big fan of systemizing things, not corporatizing them. But if you systemize inclusivity as well, it means that you give everyone in your business a fair access to company resources and fair access to opportunities.
Sure.
And if you do that, people feel valued and respected, and you get different points of views, and fair decision making comes about. And when you create that environment, you get better ideas, people trust you, you can go a long way. People will give you discretionary effort because of that inclusivity. So there's only upside to creating inclusivity, but it mustn't be left to chance, because we're all human beings.
Sure. If I think a little bit back, listening to the two of you, and also my own history of 20 odd, let me not give my age away, but 20 odd years in the industry, then we certainly have seen females and women rising to the ranks a lot more, and their views and their influence becoming much more to the fore in the South African investment, well, the global, but certainly also the South African investment landscape. So I want to move to Unati a little bit and hear your perspective and your experience. I mean, in your career, have you seen that theme of inclusivity, but also from a female perspective specifically? Have you seen that coming to the fore more, and how have you experienced that journey?
Yes, yeah, I think you certainly have seen an increased focus around inclusivity in the workplace, particularly in finance. I think a lot of research studies have shown that even today, participation of females as fund managers remains quite small. Very few female managers are actually running money, particularly individually, even though there's evidence to suggest that it's not because of lack of performance. Performance between male and female fund managers is actually on par, and mixed gender teams do exceptionally well. So diversity has a role to play in fund management. And I think since I entered the industry, asset management industry 10 years ago, I have seen a concerted effort to increase the number of female analysts, the number of female portfolio managers. In my firm where I'm involved, we've actually set targets for ourselves in terms of where we want to be by 2023, because I think we've recognized, like Cherie has said, that you have to be intentional about these things. You have to set the intention around recruiting talent, around making sure that people stay in the business and that they're growing and being given opportunities in the business so that they can be successful and climb up the corporate ladder, so to speak. Because I think that's been the other sad part I've seen since I've been involved, is that a lot of women opt out, particularly in finance. So even though lots of them will start and they'll do a BCom and they'll get the initial degree, but very few will go on to study a CFA, or very few will end up actually entering the industry. And when they do enter it, very few will stay, or will find very niche areas within fund management, and we need to change that. And really, inclusivity is about creating spaces where people who are socialized differently, and I think men and women are socialized differently, have room to express themselves and have room to bring their best selves to work, and therefore can succeed. So it's about an inner attitude of accepting that difference and celebrating it, because I think it adds to how we solve problems. And the problems we face, as Wanjiru was saying, are very complex, and we need people with different skill sets and mindsets to be able to overcome that. And so there's lots more for women to do, I think, in finance.
And clearly, we each have experienced different levels of inclusivity and what it means, and different contexts to that. You also touched on portfolio management differences, and I'm interested to have heard you say that females and males are on par from a portfolio management perspective. I'm not here today to say that females are better than men, and I won't put Zizanda on the spot to ask her that question either, but I will put her on the spot just to ask a little bit the theme of inclusivity, Zizanda, in your space. Your experience on what it means, how responsive you are to it. Are there things that you're thinking about that specifically relates to this theme of inclusivity in your environment?
Thank you, Sonia. In my environment, I mean, inclusivity goes beyond being recognized by gender or cultural orientation. So it goes beyond that. It goes to a point where you feel your contribution is valid, you are embraced, you are valued within your team. And I think it goes also, it also takes into account what you bring to the table. So if you feel welcome, you are more, you give more, you give more, you contribute more, and you participate even more.
Thanks, Zizanda. Nina, let me move over to you a little bit, just your history and your experience of how investment teams itself have changed. I mean, you've been in a couple of companies. Have it changed? Have you seen inclusivity as a theme play out differently over time? What's your perspective on that?
Yes, actually, Sonia, I want to pick up on Anati's point earlier as to what inclusivity meant for her, because I resonate with that quite a bit. Inclusivity is about making space for different perspectives, where one can capture, given different individuals, their background, whether it's from a race, a cultural, discipline, and now we're talking gender perspective, by putting in and including all these different perspectives just makes the discussions, the research process, the decision-making process a lot more robust. But I think practically, I mean, what does that mean? It's about leveling the playing field for all. Not only just including the different genders and race and all of that, but and making space for women in the boardroom. But this thing needs to be broad-based. And what I mean by that as well is it should be about broadening the space also for men in the workplace. For example, giving men more meaningful paternity leave so that they can spend time, in their children's daily life, for example. And in that space, also giving women, fair opportunity, and in the same place, in the same space, reducing the pay gap. I mean, in my experience over the last 20 plus years, Sonia, our industry has certainly come a long way.
But you also stopped counting.
I stopped. I actually made a U-turn. So, yes, in my experience over the last number of decades, our industry has certainly come a long way. Historically, very much a male-dominated industry. You're seeing a lot more diversity and a lot more inclusivity. Compared to when I first joined the industry, there are a lot of more women in senior executive roles. There are a lot more women successfully so in the front office and have not necessarily opted out. You know, they've been included. I mean, have we arrived? I don't think so. There's still a long way to go. But I'm excited about this and to be part of this journey and to watch it actually play out. We've come a long way, still a long way to go though.
So I clearly hear you talk about the fact that it's not about equality, but inclusivity and equality is not 100% the same thing. And that actually from a research, you nicely said it, the decision-making perspective, even a business culture perspective, the theme of inclusivity is something that makes us stronger together. And I like actually that perspective. So let me go to Cherie as a CEO in this space then, and ask you, Cherie, your perspective just on what introducing females in a business, what it's done to the culture, what does it bring something unique? How do you think about that?
Yes, thanks, Sonia. I just want to pick up on the point the ladies made earlier on. It's very much in the end a numbers game for us as women in the workplace, because I think research shows that between only 10 and 20% of women run money globally. So when one woman leaves the industry, we tend to feel it more. So,
Sure.
and that's so, and it, according to a citywide study that they did last year, it said it would take 127 years for us to reach gender equality in fund management, which is a long time. And so one has to be deliberate about including women when you hire. I mean, you can't leave it to chance. I think that's my point. Then when it comes to culture, of course, because women bring a different viewpoint, it's diversity of thinking. There's many forms of diversity. There's neurodiversity, how you think about the world, obviously. But in our business in particular, I have seen when we add women to the teams, it does create that depth. It sort of adds to the depth of the team. And when we do our culture check-ins and surveys, the culture scores actually bump up because of that diversity of thinking that women bring. So yes, it's a tangible positive impact. And obviously a lot more enjoyable with women in the office.
Wanjiro, maybe you again, just adding to what Cherie was just talking about, are there specific examples that you can relate to or that you've seen in the industry of how business cultures have been enriched by females being included, or maybe different research perspectives or product innovation perspectives that they brought that you can think of?
Thank you for the question, and I'm agreeing with all these fabulous women that, you know, women can only add to any organization that they join. I just want to I like doing things through stories.
Sure.
So one of the interesting stories that I have is the Nairobi Stock Exchange, which is the Kenyan equivalent to the Johannesburg Stock Exchange, put in a policy a few years ago that had two main parts to it. The first was 30% of all board members should be women, so that when a shortlist came to any company, they needed to have at least 2 women on the shortlist. And the second part of that was they reduced the number of board positions that an individual could have on the Nairobi Stock Exchange. So it stopped the circular movement. So you moved from one bank to, one gentleman moved from one bank to another bank to another bank. They limited the number to 3. Now those were just 2 simple regulatory changes that have actually changed a whole stock exchange. Because now the women, when they first go for the interview, they're nervous, they don't know what to do. But by the 10th interview, they are experts at, putting forward their name as a director. So to me, that's just one story that really can change an industry of, putting it into regulation. The other aspect that can change an industry is just us promoting each other. So whenever I'm asked for, I'm a trustee in a number of funds, do you know anyone? I say, yes, I know 3 women. Do you want an accountant, an actuary, a expert in what? I have lots of women networks that I constantly promote, so that, if we don't promote each other, we won't get promoted. Sure. So yes, we bring different voices, but we need to get into the C-suites. We need to get onto the boards. Because, if you have 30% women boards, they suddenly look for the woman CEO. They suddenly look for the woman CFO. So to me, yes, we can do a lot from the grassroots. We can, employ more. We can recruit more. But we just also need to accept that we have a position of power in the industry, and that we must spread the good word. Everyone must say, I know this person, I know that person. And even if you know, 10 or 5, that's fine. But the 10 will know 20 other people. And before we know it, we will have rooms full boards of women. So, mine is just a very practical of, you need to put in some legislation. You need to do the promotion. You need to ensure that the women have the opportunity to become the leaders that they should be and can be. And then the last one for me is to continuously promote them. So if you have a new CEO, don't look at it as she's going to be the first and the last. Just say she's going to be the first of many, with many people around her. So we need to promote each other. That's one of my other big things about diversity.
Sure.
Yeah.
And that's also, I guess, why we're having this panel conversation today. I think the more we've got these kinds of conversations as an industry, not just on female inclusivity, but inclusivity as a theme, I think the better we will be to recognize these interventions, whether soft or hard interventions that we need to have. So thank you for that. I want to move the conversation just a little bit back to the portfolio management space, as well as the product innovation space in the investment management industry. Now, if we think about females and what we bring and the unique attributes that we've got as females, I think there's a lot of research and body of research. You referred to some of it earlier, Unati as well, and Sherry actually, on some of the research that we're seeing globally on what the impact of females are in the industry and how successful and fast it is and so forth. And there's a lot of research that talks about the fact that females have unique attributes that makes them good portfolio managers. I mean, themes like having the patience to ride out volatility and not chopping and changing portfolios too much, and therefore that leading to lower portfolio churn, and ultimately potentially a better or a more robust investment delivery. So Unati, I guess my question to you is a little bit, do you resonate with that? How do you think about the unique attributes maybe that you bring and that you recognize other females bring from a portfolio management perspective?
Sure, that's a tough question. But yeah, there are lots of truth in what you say, and you're right. I mean, studies have shown that men and women do have some differences, but I think at the same time one needs to be quite careful around stereotyping, because you have seen females who exhibit very strong, what we would call traditionally masculine traits, and I think that's the whole point about inclusivity, to encourage men as well to exhibit some female traits in terms of how they do. But when it comes to portfolio construction and how men and women behave in the workplace, particularly in fund management, there is evidence that women tend to be to trade less, to tend to be less aggressive in terms of their stance, and I think it speaks to the fact that I think as women we are quite apt at managing complex systems from a very young age, where we're having to multitask and we're having to deal with lots of things that are demanding for our attention, and therefore being able to hold your attention span despite the volatility and all the different things that's happening around you, I think is a core skill. And so you're not easily, I believe, you're not easily swayed by the emotion of the moment or the anxiety of the moment, because you're able to hold these different truths and these multiple realities at the same time. And I think that's an important skill. And I think I'll go back to the point that I made, where I think there is a lot of power in having diversity within teams. So I'm not propagating for all female teams, just as I'm not propagating for all male teams. I think you want the diversity, because there are times where you need a little bit of aggression to go, and there are times where you need somebody to remind you to hold back a bit and think a bit. Then maybe let's do this trade tomorrow. And I think it's about having that sort of maturity as an investment team to debate your ideas robustly in a respectful manner, that recognizing that both people are coming from a different point of view, and to allow each other the space to say, okay, we'll do it your way, Unati. Let's wait a bit, we'll talk about it tomorrow. So it's about that respectful space, I think, that can happen. That's the magic when you're part of a portfolio management team and you're bringing all this diversity into it.
Sure, and I guess that is the beauty of diversity in a nutshell. is that it brings a balance of all of those views together, and you can find the best opportunity. And let's face it, in a competitive industry like what we've got, there's a value in that. That in itself is actually a source of alpha that you need to make sure that you exploit in the best possible way. Zizanda, I haven't done a proper study on this, but my perception is that in the fixed income space, especially in the money market space, in our industry, actually also globally, that you do get a lot of female dominance, or a lot of female representation. I don't know if that's factually correct or not, it's just my own perception. But I want to hear your perspective on, as a fixed income portfolio manager in that space, are there unique female attributes that you think makes you strong in your role, and other ladies in the industry as well?
I think there is a little bit of truth in that, because in the money market space that I am currently in, it's mainly dominated by females. So even though the fixed income in general is a male-dominated industry, but you find that in the money market space, it's only females. So I would say when it comes to investing, it has also been proved through research studies that the female managers tend to outperform male managers. Not to stereotype anyone, but it goes on to say that it's because women investors are very thorough, and they take time in thinking about their investment decisions. So the money market space is very volatile. It's as volatile as it is stable. So like you mentioned, every bit of alpha counts. So a very small margin would set you from being a first quartile to being a fourth quartile. So women tend to bring that little bit of patience, and they tend to bring in that little bit of calm, and they think and they take longer to sort of make their investment decisions. But and also the study has proven that they take lesser risk, but appropriate risk, than their male counterparts. So they're not risk averse, but they take lesser risk compared to their male counterparts. So I do agree with you that it is a very female-dominated market or industry within a male-dominated industry.
Maybe another way of thinking about it is actually from a trustee's perspective. So I'm keen to ask Wanjira just again, if you think about inclusivity and female diversity, how do you as trustees interact with investment firms? I mean, do you think about it differently if you see a male-dominated investment firm approaching you and chatting to you as a board of trustees versus a female one? Or how do you think about that dynamic playing out, and how does it influence your decision making?
Thank you for the question, because the industry has changed so much in the last 20 years. Well, if you had looked at the board of trustees maybe 30 years ago, it would have been rare to find a woman trustee. While today's boards are, there are quite a number of women. And when us as trustees in all the boards that I have been in, when we see a more diverse fund manager coming towards and coming to present to us, they are always looking at things slightly differently. They've always got a different angle. There's always, we're looking at this investment from this angle, from that angle. While traditionally they came and said, performance has been good, leave us alone. If it was a male dominated, and we'll keep giving you the performance. But the world is more complex now. We're looking at E, we're looking at S, we're looking at G, we're looking at society and how the fund manager is affecting the society and how they're improving the society. So therefore, a more diverse organization will actually give us better results in the long term, because trustees are looking more than short-term 3-month performance.
Sure.
And to achieve that, you need a more diverse team to give you those long-term returns.
So it actually is a strength in talking to boards of trustees to also have a more diverse team.
Absolutely. Diverse team in terms of culture, in terms of thought process.
Sure.
We have one team that's got a nuclear scientist as part of their team. So if, even different careers as they come through makes a huge difference in how that fund manager is perceived by the board of trustees.
Sure. And Manjira, you touched on two themes there that I quickly would like to explore with the ladies next to me. The neuroscience one she just made. I mean, you're sitting, Cherie, in a in a, I suppose, a more quantitatively systematic house yourself as a CEO, how do you feel the research culture has benefited from, I mean, you were also referring earlier to disruption as a key force that we're not struggling with, but that we're posed with as an industry.
Yeah.
So if you bring that disruption of technology and how it can influence the industry together with this inclusivity and diversity perspective, where are we from a research perspective, and how do we benefit as businesses in your mind?
Okay, so maybe I'll say it with what we have as our tagline, and that's informed by science, guided by insight. So we are systematic in our investment approach, and we leverage data. And that's what we start with. It's the starting point to put all of that together. But then we bring the human insights to that. And that's what makes it rich. So you can analyze data, Google Trends, but it makes no sense if you don't put a human brain behind the analysis of that. So if you have true diversity of race, gender, neurodiversity, as I said, background, nationality, then you can imagine the kind of perspectives that you bring to the research process. It just enhances it, makes it richer. And I think in our house, as our diversity definition has also grown, it's broadened the way that we think about our systematic process and actually strengthened it. I think where we started off 18 or 24 months ago to where we are now, just bringing in new people from different backgrounds made a massive difference. And you can see it in the evidence.
Sure.
You can see it in the output. You can see it in the team dynamic. So the point is, though, that you start with what the common theme, what we're working towards, and then you add the different layers of humanity to that. And that's quite powerful.
I was going to say, that is such a powerful perspective on it. Thank you for that. Nina, in closing, I'm going to ask you a little bit. Wanjiro was referring to E, S, and G. So from your perspective in a multi-asset class setting and also your history in the industry, do you think that social consciousness is a theme? I mean, if I look locally in South Africa and globally, it seems like social consciousness as a theme does come from a female perspective and is driven to a large extent by females being very prominent in the industry. Of course, there are lots of strong men there as well, but it does seem to be an area of application where females seem to be particularly strong. So the question to you is, do you think that ESG as an area that's advanced in the investment management industry globally has benefited from any unique female attributes that makes them particularly strong in this space? Or how do you think about that?
Yes, thank you, Sonia. I think I have to bring this back to what Wanjiro was saying a bit earlier. You know, historically, you know, it was all about the G, governance, governance, governance. And I think even as an industry locally here in South Africa, you know, we've always ticked that box really well on the governance perspective. Now what we're seeing playing out geopolitically and, you know, the moving to net zero, you know, the E and the S has been uplifted, but you'll see the big sort of social players in this is very much, you know, women coming to the fore and bringing this forward. And I think largely because, again, they do think about things differently. They do have a different perspective on the whole issue of how they've experienced, you know, the E and the S. And I think to bring it all together, the importance of it is the diversity of the thinking. I think there's a lot to say in you know, the strength and the power of the collective diverse thinking, whether it's on the E or the S, and importantly the G as well.
Thanks, Nina. Well, I think you will agree with me that diversification is a common and a core concept in investment management. By allocating assets amongst different asset classes and strategies, investors seek to reduce market volatility and achieve better risk-adjusted returns. But clearly, as you heard today, diversification as a concept goes well beyond that. I hope from the panel conversation today that you got a glimpse into how diversification can also apply to teams managing assets and allocating money. And that by including female diversity, it can have a multiplying effect that may potentially create more robust outcomes, lead to more inclusive research input, product development, and investment and business decision making. I truly believe that gender diversity, that is female and male, enhances our common creativity. It encourages the search for novel information perspectives, leading to better problem solving for challenges we are facing as an industry today. Diversity and inclusion can improve the outcomes for our investors and lead to unfettered discoveries and breakthrough innovations. So with that, I want to close off by thanking my panel of experts today for your valuable insights and also for the roles you play as females in the industry. And I want to pay homage to all females in the industry for each of your contributions to making our economy stronger and more inclusive. Thank you.
Our Deputy Chief Investment Officer, Mike Atset, will moderate the next panel discussion about the effects of Exchange Control and Regulation 28 on our industry.
Thank you, Michael. Welcome to the Mindful Moments panel discussion on going through some changes, where we focus on some of the regulatory changes that will have implications for the investment management industry. In this discussion, we're going to focus on exchange control relaxation, as well as changes to Regulation 28 of the Pension Funds Act. This is part of a complex of regulatory changes that will be impacting the investment industry going forward, and there will be additional changes that will also come to bear as we go through time. With me today is a learned panel of specialists, and I will introduce them quickly. To my left is Malungelo Zelimbola. He's the founder and CEO of Mazi Asset Management, and also previously the Chief Investment Officer at Mazi. To his left is Mohammed Sibda, a Senior Portfolio Manager at Momentum Outcome-Based Solutions, who looks after the multi-asset class portfolios with which our audience will be familiar. Next to him is Godfrey Albertine, a Portfolio Manager that focuses in the alternative asset management complex, and he looks at infrastructure and other unlisted investments. Joining me online are two further panelists, Karabo Seima, who is a high-yield credit analyst and portfolio manager looking at some of our unlisted fixed interest portfolios, as well as Professor Evan Gilbert, who's a strategist focusing on research and innovation within Momentum Investments. So thank you everybody for joining us, and we're looking forward to the panel discussion today. So Malungelo, let's start with yourself. So you've seen the changes that are coming in terms of Regulation 28 and exchange control relaxation. How do you think that's going to start impacting the portfolios that we manage for our clients?
Absolutely, Mike, and thanks for inviting me. Indeed, the change that has happened is quite drastic. And when you look back to the Pension Fund Act of 1956, as well as a promulgation of Reg 28 in 1962, where you had only 25% allocated to foreign assets, with a 5% bonus which was allocated to Africa, making it about 30% offshore. Now to move to 45% has been a drastic move. If you look at what that would be in terms of the numbers, if you take our industry as being 10 trillion rands and you allocate an extra 15% offshore, that makes about 1.5 trillion rand that's going to move from the local asset management industry to the global managers. So that's quite a big number, and it's quite drastic. And I think it's going to affect a lot of portfolios. I think it's going to bring about a huge amount of performance divergence if you look at different funds. And also it will actually introduce currency risk in our market. Should the rand, for example, strengthen, you'll find that a lot of portfolios will lose a lot of money. So it's quite a drastic change.
Yeah, it is. And you've answered the question looking at the portfolio perspective, but there's also implications for the investment management industry. How do you perceive the reaction to the local investment management industry is going to be, and managing an asset manager yourself, what kind of adaptations do you believe we will see over the next couple of years as the industry aligns to the new reality?
Great question, Mike. The impact on the asset management industry in South Africa is similar. So take 1.5 trillion rand and you take it out and allocate to foreign manager. Because what we've realized is that, a lot of commentators have mentioned that South African managers are not able to manage this vast amount of capital offshore. So you now need to bring foreign asset managers. So the impact would be the loss of assets by the local asset managers to global asset managers. And that could in fact affect our industry. Our industry would lose skills. Our industry will shrink. I think that it's going to be quite a big impact on our local industry. So it doesn't really bode well for our industry in South Africa.
Yeah, I suppose there's different mechanisms by which the industry needs to react. The one is, do they capacitate their ability to manage the offshore components of portfolios? Do they double down and look at the local asset management and the local mandates? But I mean, what is clear is there are implications, and over time we are going to have to evaluate how those implications roll out.
Yeah, just to add to that point is that indeed you'll see different business models evolving. One example would be a local manager would partner with a global manager, where they're able to provide a full suite of products and capabilities to be able to properly manage, that 45% that's allocated offshore. So those are some of the reactions and also just adjustment and adaptation by the local industry.
Yeah, it's going to be an interesting perspective to have. And just to bring in Mohammed, who manages the factor range of portfolios. Mohammed, with your hands on the lever, the allocation levers, you must have been applying a lot of time and thinking in terms of how do you react to these changes, both from exchange control as well as changes to Regulation 28. How are you thinking about these changes, and how do you believe you will start integrating these different perspectives into your portfolios?
Right, Mike, I think what I'll do is answer the question from a strategic asset allocation perspective, as well as from the actual implementation of the revised global allocation of the portfolio. So from a strategic asset allocation perspective, our model suggests that a higher global allocation increases the probability of achieving the respective outcomes that we've set for our portfolios. I think the real essence of the question then is the timing of these changes, and I think given that our view is we prefer local asset classes over global asset classes at this specific point in the cycle, we've just been very circumspect in terms of the actual implementation of this change. As Malungelo said, 30 to 45 is a big number, and in terms of the implications, in terms of the cash flow management, etc. It's not as easy as when you had changes like 25 to 30, for example, and especially given the current context where the valuations on South African asset classes are just stacked in your favor. So if you just take local bonds versus global bonds, for example, where our yields are trading at anywhere between 10 and 12, and you compare that to global bond yields of anything between 1.5% to 3%, with the expectation of it rising even further, one just needs to be very careful in terms of making these very big changes in the portfolios. And also to Malungelo's point, currency management is also going to be a more important aspect in the portfolio management, because if you take, for example, a conservative portfolio where you have, for example, 25 or 30% offshore, big changes in the currency movement can actually have detrimental impacts and effects on those particular members. So it's not as clear in terms of moving from 30 to 45 within our heartbeat right now. We're just applying our minds in terms of how we go about increasing this actual increase in allowance. We're doing it very slowly, very gradually. The other thing is also gives us a greater opportunity set. So it might not just be global equity, global bonds, and global property you'll find in our portfolios going forward. There's scope now to actually increase that opportunity set or the investable universe, not just in terms of asset classes, but potentially asset strategies in the portfolio as well.
I mean, what's clear is that there is going to be a paradigm shift. At 45% offshore exposure, it is a significant implications for portfolios, and we will have to have far more rigorous and tight integration between local and global portfolios. So Evan, I want to direct the next question to you. As a researcher and strategist looking at the field, how are you thinking about leading our research initiatives in terms of that tighter integration between local and global components of portfolios?
Thanks, Mike. This change in exchange controls is really a fundamental change in the industry, and it has great implications from us from a solution design perspective, as well as I think from the industry itself's perspective and the ability of the local asset managers to manage international portfolios properly. Given our outcomes-based investing solution, we can't anymore sort of see the offshore component as a separate part of the puzzle. We have to design it much more closely, much more carefully, given that 45% of the assets might be sitting in that space. In particular, it's the equity building block, which we are looking at from a research perspective. We're looking at ways of integrating the exposures that we want and that we can't get from the local investment universe. It's a much bigger universe, and it gives us a lot of flexibility to do that. However, the challenge is from a capability perspective, because to do that effectively, to integrate or see the offshore solution as a complement to our local solutions and design them in an integrated fashion means that you really need to have capabilities to properly assess the global investment universe from an outcomes-based investing solution. And to that extent, having a partnership like we do with Robeco is a very, very, very powerful weapon or a very powerful tool in terms of our ability to solve this problem. And so the collaboration with an international research provider, as well as a provider of tailored solutions that can meet our specific outcomes-based investment needs, is an important part of our response to this opportunity, frankly, which the exchange control relaxation is offering us.
Maybe you've sketched the holistic framework and approach. Can you maybe give us an indication of the specific types of projects that you are currently working with in conjunction with Robeco, just that our investors can get a little bit of a foretaste of the types of thinking and the types of changes that we will be bringing into the portfolios over time?
Sure. Mike, the opportunity to integrate the global element of portfolios with the local is really exciting, because if we look at these portfolios from an ESG perspective, environmental, social governance perspective, and from an equity risk factor premium perspective, having access to these global assets is really, really, really exciting, because it allows us to complement a lot of the shortcomings that we're seeing in terms of the local investment universe. Our local equity markets are relatively small. They're very, very concentrated, and from a sort of environmental perspective are relatively dirty in terms of carbon emissions and other challenges. So what we're doing is combining both the design of the local and the offshore through the lenses of the ESG and the equity factor risk premium. And what we're going to do is use or design the offshore sort of components as complements to offset the challenges that we're facing here. So for example, if we're wanting to reduce our carbon emissions in our portfolios, we're quite limited in terms of the choices that we have locally. I mean, exclusion is not really, it's a very expensive option to apply domestically. And so effectively from a risk return perspective, we can't sort of simply eliminate the dirty companies on the JSE. But what we can do is design complementary portfolios offshore to offset that negative carbon emissions, which means that the entire solution from an equity perspective, from a South Africa's investors perspective, is much cleaner than it would be previous to these changes. The other element of the solution that we're designing in integrated fashion is around equity risk factors. We use this, we design exposures to factors such as value, momentum, quality, low volatility. And by doing research into the relationships between the factor return patterns that we're getting from our domestic equity portfolios and the offshore portfolios, and combining them to give us the highest probability of achieving the return outcomes that we are designing our portfolios around, is the way that we're going to achieve that. So it's focusing on ESG, it's focusing on equity risk factors and having optimal exposures to both of those.
Thanks, Evan. And I just want to come back to Malungelo. You've heard a little bit of the description and the thinking of how we want to approach the global opportunity set. You also spoke a little bit earlier about the business model and the need for the adoption of different models by the investment management industry. I just want to get your perspective and potential insight in terms of how you think it's likely to play out going. How does adaptation happen within the investment landscape?
Thank you, Mike. Indeed, the change has been fundamental. And I think for me to begin to address the change, one need to reset. An asset manager need to reset and redesign the product that they're offering. It's just not going to be an additional allocation from 30 to 45. It has to be a reset situation given the fundamental change, and also to redesign, the product offering. And in redesigning the product offering, you're gonna need the skills and the capability. So how do you get those skills and capability? Hence the kind of partnerships that we're talking about in terms of local asset managers partnering with offshore managers to be able to properly address the product offering to our clients. But it can just not be, a continuation of what we had before. I think it needs a reset. It needs a product redesign. It also needs to really look into the whole capability and hence partnerships that I've just mentioned.
Thanks, Malungelo. The change in exchange control is a significant impact for the investment management industry and will have far-reaching implications. It's one of the reasons that over the years we have established and built a partnership with Robeco and worked far more closely with our London team. Evan is his research capacity is quite close to those initiatives. And Evan, you did want to add something after listening to Malungelo's response.
Yes, thanks. I think Malungelo is totally correct in saying that the partnership model is very, very important for investment management companies going forward. However, I do think that the nature of the partnership is very important in terms of success from an investment perspective. The ability to create a unique solution for your South African clients, taking into account the South African perspective that our clients are going to experience the solution from, is vital. And so what you need is a research partner with very strong research capabilities and very strong abilities to create something that's unique and that fits your needs as a South African investment management company. And I think that's where Robeco is really, really exciting from our perspective, because they have exactly those two skill sets that we need and that we are using in terms of the development of this bespoke offshore completion strategy from a South African perspective. So I think it's correct in saying that the partnership model is the right way forward, or it's an important way forward. But it's the choice of partner and the ability of that partner to give you something that you need or that you can co-create with them. I think that's going to be vital in terms of determining the success of that approach.
Yeah, I mean, that's critical input and reasoning. Just looking back for a second, the changes to exchange control is a significant implication for the investment management industry. And in a sense, it overshadows what is arguably another big impact in the local industry and is being driven from the presidential perspective, and that's the investment in local infrastructure. So we are finding ourselves in a situation where, with the relaxation of exchange control, there's the very real probability that there's going to be less investable assets in the local landscape. We need to evaluate how that plays out. But at the same time, there's a critical shortage and need for infrastructure investment and a strong drive and push from the presidential perspective to support infrastructure investments that are both profitable and needed. So Godfrey, just in terms of your experience and what you've seen, how the infrastructure investment opportunity set is unfolding, What is your current perspective on the changes to regulation, and how do you believe that will play out in the context of everything that's happening?
Thanks very much for that, Mark. I think if you look at the South African economy, there's been chronic underinvestment in infrastructure for an extended period of time. We topped out with gross fixed capital formation at around 22% of GDP just before the 2010 World Cup, and has been on an extended downtrend ever since. The most recent figures around about 13%. So we need to get that number up to around 30% to really to get the efficiencies that infrastructure can bring to the broader economy. So there is scope for significant investment in infrastructure. On the other hand, we also know that the fiscal balance sheet is very stretched. So there isn't a lot of room for government, or they certainly can't do it on its own. So there is a significant room for private capital to invest into infrastructure. And now we've seen, I think ASISA did a survey of its members at the end of last year, and that saw that infrastructure investment, so this is both listed and unlisted, was around 280 billion, and with less than 100 billion of that in the unlisted space. So if you think, now Malungelo mentioned earlier, the asset management industry has 10 trillion under management. So just from that perspective, the infrastructure exposure is less than 3% of the total funds under management. So there is a lot of scope to increase the number very significantly. A lot of investors will have some exposure to infrastructure already, through listed bonds such as the municipal bonds or Sanral, Transnet, Eskom and the like. But there's a whole plethora of other opportunities in the unlisted space, which we think is going to become available to investors, a much broader number of investors, and they certainly should consider that in the investment portfolios. It brings the possibility of inflation protection, diversification from other things which you have in your portfolio. So it does give a lot of scope to improve the long-term return potential of your portfolio. But of course, it is a very specialized space. So we've seen a number of specialist infrastructure managers come up of late, but there are also managers who have been investing in this space for a long time. So just investors and pension fund trustees need to be very careful about who they partner with. Partner with someone who's had the experience, who has the pipeline of investable deals, and who can execute those to the advantage of their portfolios long term.
Yeah, and I think that's a reality. There's good projects and there's not so good projects. I think there's a lot of hygiene factors that we need to put in place. One is the trust deficit that we have in government and government projects. So a new compact needs to be reestablished, and it's something that will take some time and success. So we are supportive of infrastructure investments, very mindful of the complication and the limited resources that are available. So not only does government have limited resources to allocate, the private sector also needs to balance a lot of competing priorities in terms of how they're making allocation decisions. And just bringing in Mohammed, I mean, you sitting at the coalface, you need to make choices in terms of increasing the offshore exposure, at the same time looking at desirable infrastructure investments, both from a return perspective as well as from a social needs perspective. So how do you think about balancing those trade-offs when you think, okay, looking at the new opportunity sets, how do I tackle this?
Yeah, so I think it's quite an interesting challenge that we have at the moment. I think maybe at the outset, let me just categorically state that we are in full support for increasing our allocation to infrastructure type investments in our portfolios. As good citizens of the country, we understand the immense need for these type of investments, and we're going to do whatever it takes to support these initiatives in a risk-adjusted manner. Okay, so I think you touched on the transparency, etc. That's going to be one of the more important things that we need to be comfortable with in terms of when we allocate to these types of investments. What we're entering into, what are the terms, etc. And I think from a industry perspective, there's lots of education that needs to take place. Godfrey has spoken about some of the specialists in the field, but I think as more people come into the market, there's going to be obviously greater understanding of the asset class. The other thing is, from our perspective, we need to also educate boards of trustees and, importantly, members in terms of why we're allocating and what are the risk return dynamics that comes with this particular asset class. So I think in terms of what we need to educate clients on specifically is the illiquidity that is introduced from when you invest in these types of strategies. Typically these strategies have a long lifespan, anywhere between 5 to 10 years. Or when we allocate, we're going to make sure that we diversify not just the duration risk, but also the capital structure risk that you introduce in the portfolio. We might invest in bond-like type instruments as well as equity-like instruments, and clients need to understand those types of trade-offs that also that introduced into the portfolio. And then maybe just finally, right now, we've already included some of these strategies in the portfolios. We've been we've been fortunate that we've got the pipeline. We spoke about that, and we've also had reasonable returns coming from these portfolios. I think from an infrastructure perspective, from an outcomes-based portfolio, it ticks all the right boxes. Upfront, once you enter into the investment, the return profile. These types of strategies, have got a strong inflation underpin, and so it's almost you can bank, some type of returns, into the broader portfolio. And for us, it's all about, balancing that with the liquidity or the illiquidity, the risk premium as well. That comes as a function of introducing these asset classes into a portfolio.
I mean, the one thing to bear in mind is the focus on infrastructure may give you the impression that these types of investments haven't happened in the past. And I think it's important just to reiterate that infrastructure investing, as Godfrey talked about a little bit earlier, about gross capital formation in the run-up to the World Cup, there's a lot of investment that has been made. And as a business, we've had a lot of experience in making infrastructure-related investments, maybe not with a specific focal point on or lens on specifically infrastructure investment. And being part of a bigger investment management organization, we can lean off a diversity of skills. And to that extent, I do want to direct the next question to Karabo, because a lot of the infrastructure type investments, the type of investment vehicles that will be invested in are going to be fixed interest and unlisted by nature. And Karabo, with your experience in the high yield space, what do you believe are some of the attributes that we should be considering and are considering when we look at investing in these slightly less liquid investment opportunities?
Thanks, Mike. I think in many countries, including South Africa, a large amount of the infrastructure that has happened in unlisted space. And it's happened through the project finance construct. And that's a very good thing, given the fact that, we've got a lot of governance challenges within our society at the moment. So the nice thing about project finance is that it's an efficient and a transparent way of institutional investors essentially co-investing with industry and the public sector to bring, to facilitate the provision of services that we would have historically just left to the government to provide. So in as much as we would like to see each and every investor investing in each and every project out there, that it's not feasible. Generally, larger players are the ones who participate in these transactions. And the reason for that is it's very difficult for a sponsor or an equity investor to herd a large amount of investors over the line while it's also going through multiples of regulatory hurdles. And on top of that, these transactions are very long-term in nature. So disruptions do happen. So it is also a challenge to the sponsor to be able to get a whole multitude of investors around the table, to get approvals in place, to be able to get the asset performing again. So where momentum, as you've mentioned, where momentum investment benefits is that we act collaboratively with other teams within the organization. So in as much as we all independently will make a call about whether an asset is a quality asset and it's worth going into, ultimately, if we find ourselves aligned, we would all put our bids together and place a single bid on the table. And that gives us, one, ensures participation of our clients in good quality projects, while at the same time also giving us muscle should tough conversations ever need to essentially happen. And so therefore empowering us to protect our investors instead of just buying small positions from other entities and then essentially not being powerful to do anything when those tough conversations have to come, essentially arise, I guess. And another thing to consider is that you can't be, passive in your approach with these kind of investments. And you don't have the benefit of an external credit agency who's going to review the asset and give you an opinion. It's going to take a lot of time. It's going to take a lot of effort to get your mind around the technical aspects of the transaction, around its environmental and financial viability. So, and what we've seen is historically, these skills have been in the DFIs, in the banks, and in the life insurers, because they were initially the parties that supported this asset class. Again, as part of a bigger group, Momentum MMH has been investing in these assets pre and post construction for a very long time. So we have the skills in-house that we can leverage off. Also within Momentum Investments, we have been building in skills. We've bought in skills from other life insurers. So we are well positioned to participate in an asset class that has proven itself quite defensive, especially during the COVID period where it showed very low correlations to any other asset class that we have in most of our portfolio. And ultimately, I think I just want to mention that where you participate in the lifespan of this asset, whether you're going to participate in the construction phase or you're going to participate in the operating phase, it's going to depend on the construct of your mandate. For a close-ended fund, you are probably well positioned to participate in the construction phase, where you're going to have regular drawdowns, where there's going to be interest rate roll-ups, and where you would have delays because construction by its nature will obviously bring along delays. However, for open-ended funds, the kind of funds we manage in the fixed income team, the operating phase makes more sense for us, where both interest and principal are being repaid. It's a single outlay of capital at a point in time. So that works better for us because income generation is obviously a key outcome for our portfolios. And over and above that, and another consideration is that the credit risk of these assets actually changes over the life of the investment. Whereas initially your risk is around the sponsor, around the OEM and the contractor. As soon as you move into an operating phase, then you're exposed to your off-taker and obviously the operator of the project. Now, your off-taker would generally be, with most of the infrastructure projects, it's generally been government. But obviously with the liberalization of power generation in South Africa, you might see corporates also take on that off-take agreements. And so again, for us in fixed income, where capital preservation is a key outcome for our clients, the operating phase makes more sense for us, where we have strong off-taker risk there, as opposed to taking construction risk and potentially delays in cash flows to our clients. So yeah, I think I'll leave it for now, Mike.
Yeah, thanks, Karob. You raise a couple of interesting points. The one is that infrastructure projects can be big projects. So to have a meaningful impact in shaping the project, you do need scale. And that's one of the benefits of being part of a bigger organization. The other issue that you touched on, I think it's quite important to bring Godfrey in at this point. The fixed income team looks at a specific part of the capital structure. But Godfrey, as the infrastructure portfolio manager, you've got the ability to work across the capital structure. So can you maybe just touch on where you see the opportunities and how you're thinking about what makes a good infrastructure investment that you consider including in your portfolio?
Right. Thanks for that, Mike. So I think what we look at firstly is the team that you are betting on, the management team of the project. So are they able to execute, build whatever project is being built to budget, and then operate it through the operating phase, as Karabo has mentioned. So that is the first point. So if you trust this team, well, then you can make decisions from there. I think now in the infrastructure space, what you need to consider is these are typically, as been mentioned, these are large capital projects. So you have something that you are building, and so there's a capex period up front where you are putting in all the capital. During that period of time, you're earning no revenue. So until the point where you switch the thing on and now starts operating, that's when the revenue starts being earned. And so where Karabo and her team would play is kind of more on the fixed income side. As an equity investor, your cash flows are very much back-ended. And I think what we particularly look at, because we can't wait 15 years to receive our first dividend. So we are very mindful of looking at the specific cash flows of the project to see how the shareholders, the equity holders, could maybe get at least a trickle dividend, or what is the possibility of refinancing the project, which might bring sort of more earlier cash flows to the shareholders as well. So the cash flow profile of the project is very key to what we look at. And in that vein, we've kind of found secondary market projects to be quite interesting. So if you kind of think about what's happening now in the power generation space with the successive rounds of the IPP project, and we've seen the project IRRs and those come down very significantly to the point where now they look quite unattractive. But in the secondary market, so for earlier rounds, we are finding some very interesting opportunities, which are giving very decent returns, inflation-related returns, and we are also, because those are operating projects, we are closer to the cash flows. And so that is the kind of thing that we look at to in order to lower the risk profile for our clients that we are investing.
I mean, just to touch on, in a large-scale project, the ability to identify, execute, and exit a project requires a high degree of collaboration across a multiplicity of skills. So, Karabo, just your perspectives in terms of how do complementary skill set come together, and sitting on the fixed interest side, how do you view the need and the rationale for teams working together on identification and investment into infrastructure projects?
I think it's very important for teams to work together, because if we are able to go in as Momentum Metropolitan across the capital structure, as I said, we are then able to position ourselves as a scalable investor and able to shape and better protect our investors' interests. And also, in as much as I am definitely not able to take 17-year risk, Godfrey and maybe even our BSM counterparts could take that risk and later sell on part of that portion into our portfolios. And then that it actually gives them the opportunity to optimize their portfolios, while we also benefit from investing in good quality assets, but for maturities that better fit our portfolios. So it actually would be remiss and be irresponsible of us towards our clients if we did not collaborate within the group.
Thanks, Karabo. I mean, what's clear is these types of projects require an ecosystem of skills. And what's also clear, having listened to the panel, and as we start to conclude, we are going through a lot of changes, and they're going to have implications for how we think about and manage our portfolios. And as Momentum Investments, we are very mindful as custodians of your capital that we want to do this responsibly. Before I conclude, I just want to give the panelists an opportunity for closing comments. So, Malungelo, having listened through the discussion, what are your final thoughts for our audience?
Thank you very much, Mike. It's really been a great discussion. And for me, as I've said earlier, this is a drastic change. This is a fundamental change. And we don't have to use status quo and modus operandi to go forward. We need to reset. We need to look at product redesigns. We need to look at the capabilities and skills, and collaboration is also a big part of that, of different teams collaborating, looking at things like currency risk, looking at things like liquidity risk, where you've got long-term assets being infrastructure, where you locked in, where investor is locked in for 10 to 15 years, and what that means for clients, especially those that would be retiring while the assets are locked into those long-term assets. And for me, again, is the ESG issue in conclusion, is that, especially for a country like South Africa, where you've been, you had situations of unemployment, poverty, and where we need impact from some of these investments, and the competition, for that capital, to take away 45% into the global space, while there's a big need for infrastructure investment to create jobs, to develop our economy, as well as, employ our youth. And that's the S in the ESG that we particularly need to look at as South Africans. So really, this is complex. This needs, proper application of our minds. You don't need to rush to, or solve for 45%. We need to really apply our mind and make sure that we come up with a sustainable portfolios that will serve ultimately the investors or the pension fund members.
Thank you, Malungelo. Karabo, can I give you an opportunity for some concluding thoughts?
Yeah, I think I just would like to say that the infrastructure is a great defensive asset to include in any portfolio, and it has a very strong impact angle, while also giving you healthy risk-adjusted returns. But I think one must remember that it involves a lot of hard work. It is not it's not an easy lunch. So one has to find the right people with the right skills to be able to invest your investment in the most responsible way.
Thanks, Karabo. And Godfrey, that opens the platform for your final comments.
Yes, so exactly as Karabo said, I think this space is very interesting, and it's going to be quite an exciting space to invest over the next couple of years coming ahead. Now, these investments, they do offer a lot of inflation protection, and they are long-term investors, so long-term investments. So for long-term investors who are looking for a good space to invest, I think the infrastructure space is the place to be.
Thanks, Godfrey. And Evan, your views?
Thanks, Mike. Yeah, look, I think with change, Malungelo is correct. We're going through big changes. There's great opportunities. And I think, as Karabo said, if you do your homework and you do the hard yards, I think it's a wonderful opportunity for us to actually improve the investment performance for our clients. So I'm certainly very excited by the opportunities that this provides. But yeah, it will require a lot of work to make sure you do it well.
Thanks, Evan. And Mohammed, you've been in the hot seat, you with the levers on the capital allocation decisions. What are your final thoughts for your investors?
Yeah, so I think, Mike, firstly, both these opportunities, just going forward, is going to enhance, the performance delivery of these portfolios. For us as a team, it's firstly, identifying the right infrastructure projects and understanding, the returns and the risks that come with it before inclusion. I think clients must, must understand that, that we're not just going to be investing for the sake of it. Every investment that we put into the portfolio will be a calculated investment into the portfolio. So maybe clients must just get that sense of comfort. So, and then the other one is, the whole offshore increase, as everyone has said, is something that we all need to apply our minds to. In terms of the asset classes that we introduce, the strategies I spoke about, for example, what type of equity you want to have. Evan has spoken about the more integrated approach in terms of the local and global equity. All these changes and ideas are going to be, for us, very, very interesting in terms of how it all comes together. We just want to tell our clients that, we are applying our minds to all these changes, in a very responsible manner. We're not going to be rushing into any kind of, knee-jerk type of changes to the portfolios. We're going to take our time and incorporate these changes in a very responsible manner.
Thanks, Mo. And audience, thank you for your time with us. As you can see, there's a lot of changes on the horizon, and the investment team are really applying their mind, and I truly believe they've got the right skill set, capabilities and experience to responsibly navigate your investments. So once again, thank you to my panelists. It has been an insightful conversation, and I've enjoyed the perspectives and insights. And audience, thank you for your attendance. And remember, with us at Momentum Investments, investing is personal.
Next up is Mohammed Sibda, a Senior Solutions Portfolio Manager, who will give us an economic overview and an update on our multi-asset class portfolio ranges.
It has certainly been an interesting and challenging first half of 2022. The macroeconomic backdrop has posed a number of challenges to investors across the globe. At the onset of the year, inflation across the developed world was ticking up on the back of higher oil and food prices and the continued shortage of certain goods as a result of the COVID pandemic. This was further exacerbated by the Russian-Ukraine crisis and has now led to multi-year high inflation numbers in most parts of the world. Central banks have taken decisive action in a bid to contain these inflationary pressures and have surprised the markets with the extent of rate hikes and, perhaps more importantly, the language and message to the market that they will continue on this rate hike path to deliver on the inflation targeting mandate. This has led to national concerns regarding the possibility of a policy error and the increased probability of a marked slowdown in economic growth, stagflation, and even a possible global recession. These concerns have spilled over to investment markets, with both equity and bond markets experiencing drawdowns year to date. Sell-off in equity markets has been particularly severe, broad-based, and in certain instances indiscriminate, and has created opportunities once again for patient investors who are willing to take a longer-term view. Looking at the asset class returns to the end of July, one can observe that local asset classes have fared better than global asset classes despite the rand weakness experienced during this period. The year-to-date numbers also highlight that this was one of those periods where most asset classes were negative and that only local cash and the dollar delivered positive returns. These returns explain the negative year-to-date and mid-single-digit portfolio returns for the 12 months to July. Within local equity, there was also a meaningful dispersion of returns within the broader sectors and similarly so within the global regions. Global growth concerns have led to lower commodity prices, which in turn have resulted in negative returns. The performance of the financial index was largely driven by banking stocks, which have benefited from higher interest rates as well as resilient balance sheets. The industrial sector was weighed down by counters such as MTN, Richemont, and Naspers. US equity markets were affected by the derating of long-duration growth stocks. That includes technology and selected consumer-related stocks, which have come under pressure given the recent rate hikes. Emerging markets have been weak on the back of negative sentiment as well as country-related risks, as China and Russian stocks were both material weightings in the index. I will now focus on the portfolio positioning. Our preferred asset classes remain local and global equity, as we think the recent sell-off provides investors attractive returns over the medium to longer term. As mentioned earlier, the selling has been indiscriminate and certain shares are now trading at reasonable valuations and in particular cases at very attractive dividend yields. It is, however, worth reminding the attendees that our portfolios are always well diversified and we are mindful to not place any big positions within a style or sector. Currently, within the local equity portfolio, we have a slight tilt towards defensive shares. Examples include British American Tobacco, ABI InBev, Richemont, Shoprite and Naspers. These type of shares have contributed to relative performance over the last quarter. We also have a decent allocation to SA Inc. shares like banks, retailers and healthcare stocks. And finally, even though the resource exposure has reduced over the last 12 months, we still retain a healthy allocation to this sector with exposure in the likes of Cecil, Diversified Miners, Anglos and Billiton and Platinum Counters. Within our active global equity building block, we have a well-balanced portfolio that is diversified across both developed and emerging markets. There is further diversification between strategies and sectors. The portfolio is tilted towards quality or defensive companies and value strategies. These include the financial and energy sectors, but we still have a decent allocation to high growth strategies, which includes the likes of US tech giants, Apple, Amazon, Microsoft, etc. Some of these more established and high quality tech stocks are now also trading at better valuations after the recent sell-off. The local and global equity building blocks have held up relatively well in 2022, managing to perform their respective benchmarks. We are comfortable with the positioning given the current macro backdrop, valuations and outlook. We are equally positive on SA bonds given the current nominal yield of 9 to 12% depending on the duration. In addition to these returns being almost equity-like, SA yields are also one of the more attractive from a global perspective. A change in EM sentiment or a few positive political reform measures could provide the huge value unlock in this asset class. We are still cautious about the SA property sector and retain a slight underweight position to this asset class. We are particularly concerned about the office sector where the vacancy rates remain stubbornly high in the upper teens in certain regions. We therefore prefer to spend our risk budget on SA equities and SA bonds despite the more reasonable valuations of property counters. We are neutral on global property. As mentioned in our April update, the forward-looking returns have improved quite considerably and we have subsequently added to this asset class. Local cash rates have increased over the last year but are still negative in real terms. The cash exposure in the portfolio is more of a result of risk mitigation rather than for return reasons. Our least attractive asset class from a returns perspective is still global bonds. From a valuation perspective, global bonds are expensive and rising interest rates across the developed world offer very little margin of safety. We are, however, closely monitoring the rates for a better entry point. Just a few comments on our global allocation. The global exposure is currently between 26 and 31% across the portfolio range. We have been deliberately very selective in increasing the global exposure, given that we prefer local asset classes from a valuation perspective. We will, however, continue to manage this position in a reasonable and prudent manner and will not necessarily rush to increase the global exposure in our portfolios. To summarize, our portfolios have the appropriate allocation to growth and income producing asset classes, but are marginally overweight local and global equity. We also have exposure to selected strategies that are uncorrelated to the traditional asset classes. Examples of these include private equity, allocation to hedge fund of funds, as well as to infrastructure and renewable energy projects. These strategies have contributed to portfolio returns over the last 12 months. Private equity and direct property in particular have benefited from the relaxation of the stringent COVID measures, and the cash flows from these asset classes have improved markedly. To conclude, our portfolios are well diversified and we are confident that our solutions will meet their objectives over the respective investment horizons. Our outcome-based investing philosophy, underpinned by our rigorous risk management approach, provides a robust framework for managing our portfolios prudently. We are comfortable with the positioning of the portfolios within the current geopolitical and economic context and believe they are well positioned to navigate this environment. Thank you.
Next, we will hear from another one of our solutions portfolio managers, Kudzai Zizo, about our responsible investing initiatives.
Good day, everyone. Let me take you through some of the responsible investing themes we have seen prevalent in our portfolios. First off, transformation. A couple of years ago, we set about a transformation plan with the aim of investing in more transformed managers as we deploy capital to the various strategies utilized in our solutions. While this ties in strongly to the social aspect of ESG, particularly within our South African asset management industry, inclusivity and diversity are key considerations. Not only do diverse and inclusive practices go a long way in resolving socioeconomic justice issues, the domino effect is even more far-reaching, not only leading to improved overall business outcomes for our underlying asset managers, but also makes for stronger teams that easily attract and retain top talent. When making investment decisions, we follow a few guiding principles in executing our transformation plan. The most important and overarching action is to deliver on our portfolio's risk and return objectives. So first and foremost, we solve for what is best suitable for our investment case. In other words, the investment case prevails. We then shortlist prospective asset managers in a way that supports transformation. Key to this is looking out for authentic and broad-based transformation. A powerful tool we have at our disposal is the active engagement we have with both our prospective and incumbent underlying asset managers. Pleasingly, large strides have already been made organically within the industry over the last few years. However, active engagement and a deliberate plan propels the industry further to achieve a more equitable racial and gender balance. Key to our plan is how we measure our progress. We seek to provide accountability to all stakeholders in a way that is specific, measurable, and verifiable. To this end, we utilize well-known industry surveys and metrics as tools. We regularly monitor granular aspects of the plan, such as total empowerment shareholding, the number and gender of Black investment professionals, as well as procurement. All of this facilitates better engagement with our underlying asset managers. As the chart shows, we have been able to achieve better than our initially planned exposure to transformed managers. And because the pace of changes also happening in the industry is encouraging, we have upwardly revised our targets and continue to keep our pulse on the ever-changing landscape. Moving on to impact themes. As a corporate, Momentum Metropolitan is committed to 6 of the 17 UN Sustainable Development Goals, with a particular focus to ensuring healthy lives and promoting the well-being for all ages. Ensuring inclusive and equitable quality education to promote lifelong learning opportunities for all. To ensure access to affordable, reliable, sustainable, and modern energy for all, as we are currently making impact in this in large strides. To promote sustained, inclusive, and sustainable economic growth, full and productive employment, and decent work for all. To build resilient infrastructure, promote inclusive and sustainable industrialization, and foster innovation. To take urgent action to combat climate change and its impacts. As we engage with our underlying managers and go about the day-to-day management of our portfolios, it is interesting how the different themes in ESG dominate the agenda, depending on what is happening in the world. For some time, all the corporate failures to date shone a bright light on the role of sound governance. Then, social themes understandably dominated. It remains imperative that we direct our investments to where deep social impact and multiplier effects can be felt in the communities where they are most needed. Now, due to the war in Ukraine and the energy crisis, environmental issues are one of the main sustainable investment issues to be balanced, as all stakeholders reconcile between the energy security needed today with the net zero commitments necessary for tomorrow. It seems like with every season, the climate change effects are more pronounced. One just has to refer to the recent 40-degree weather experienced in the UK and the extremely cold winters in Joburg, neither of which our houses are purpose-built for. While we believe all the SDGs underpin all that we do, if we align our investments with the goals in focus, the impact we can deliver on will be more significant. To this end, we have committed capital to the Amandla Renewable Energy Fund, the Student Accommodation Impact Fund, and the African Infrastructure Investment Fund, all of which make up the Real Assets program. In closing, when it comes to responsible investing, we are at the forefront of global best practice. We stay abreast of global developments driving prevalent themes, and we make it a priority to upskill ourselves. We were one of the first signatories in South Africa to PRI. We are the first South African insurer to be a TCFD supporter, and we're part of the Carbon Disclosures Project, as well as an industry discussion group, Climate Action 100+. We were one of the first signatories to the Just Transition Statement, and we have completed the PRI African Climate Awareness course. ESG is a fully integrated approach, where active ownership is a key lever, and ESG factors are applied at every decision point of our investment process. We are transparent and believe in evidence-based examples where we can fully demonstrate the tangible impact our investments can have on real people and their lives. ESG is a journey, one we have been on for a long time. A fine balance is required between adequate compensation and risk mitigation on one side and its ESG risk factors on the other side. It is therefore incumbent on us to prioritize generating long-term sustainable growth in our portfolios while doing good wherever we can and thinking ahead into the world into which we will retire into. Thank you.
Wayne Dennehy, our Head of Institutional Distribution, will close the webinar.
Well, that brings us to the end of the Mindful Moments webinar, and I hope that you managed to get as much out of the session as what I did. The markets, pretty much from the start of COVID in 2020, have been challenging for portfolio managers to navigate, a challenge for intermediaries to navigate, and no doubt a challenge for our end-state investors to just do nothing and stay invested. Diversity in any investment team is such an important component to get right, to get the most out of the team. We embrace diversity in all aspects at Momentum Investments, and the gender diversity across the team is something that we are really proud of, and it makes the team so much better. To all the phenomenal ladies across the investment team, we could not do this without you. The changes to Regulation 28 that allows funds to take up to 45% of their assets offshore is fantastic. And as you have heard this morning, it's great to widen the investment opportunity set and to have a wider investment spectrum that we can choose from. The challenge, though, is not so much what the answer is, but how we then implement and move the funds into their desired end states. We are doing an enormous amount of work with Momentum Global Investment Managers and Robeco, our global partners, and you can expect to see some of this thought leadership and additional comments on this topic very soon. I also believe that a consequence of this wider investment opportunity set is that in time, it's going to lead to a much wider range between how funds perform relative to one another. At Momentum Investments, your money is in safe hands. You have an experienced, diversified, and market-leading team taking care of your money. A team that continues to show innovation, thought leadership in portfolio construction, in portfolio design, and in the implementation. CPD certificates will be emailed out soon, and we look forward to hosting you again at one of our future events. On behalf of myself, Wayne Dennehy, and the investment team, we thank you for choosing to spend your precious time with us this morning. See you soon.
And now, a special announcement from Theodore Blanche.
Hello everyone. At Momentum Investments, we believe that investing is personal, and nothing showcases this more than our outcome-based investing philosophy, where the client's investment goal is at the center of how we construct and manage portfolios. What makes investing even more personal for us is the people behind the numbers, the fact sheets and the reporting. It's our people who establish long-term relationships with our clients, consultants, and others in the industry. The person behind our investment philosophy and many of these relationships in our business has been Sonia Saunderson, our Chief Investment Officer. Sonia has enjoyed a long and very successful career at Momentum over the last 22 years. She started way back in 1999 as an actuarial analyst in the business and held various leadership positions during the years. She's been instrumental in building up a formidable investment team in Momentum, and we're immensely proud of the investment philosophy, portfolios and processes that have been established under her stewardship. It's with mixed emotions then that we have to announce that Sonia has decided to take on a new opportunity in the industry. She'll be taking up the position of Chief Investment Officer at the Eskom Pension and Provident Fund from 1 November, and she'll be handing over her duties at Momentum over the coming months. While we're certainly sad to see Sonia go, we're proud of the contribution she's made to our business and excited on her behalf for this next chapter in her career. Sonia leaves the business in an exceptionally good position. Our great team of experienced investment professionals will continue to deliver the experience our investors are accustomed to. Plans to formalize the leadership structure within the investment team is underway in consultation with the team, and more information will be provided in due course. Sonia is excited to play a different role in the investment market and to continue contributing to the evolution of our industry. We wish her success in her future endeavors and look forward to seeing her succeed in her new role. Thank you again for your attendance today.